Hey everybody, Steve Howe here with RE/MAX Advantage Plus. Just want to give you my predictions for Minnesota housing market in 2014. I know we've got a lot of things going on right now with the Federal Reserve tapering their quantitative easing. We've got sale prices that have come up quite a bit in the past year or two, and then we've got inventory that's at really low levels. So I want to take a look at some numbers with you and then maybe get your thoughts on where you think the housing market is going to be going in 2014.
So obviously one of the key things we want to look at is price, and we're going to look at the most recent data for median sale price. And the reason we're using median sale price and not average sale price is because sometimes the higher end listings can skew the numbers of an average sale price. And so we're going to use median, which again just means the middle number of all the different sales laid out from month to month. And so as you'll notice over here, these columns on the right side, these are basically break down the most recent kind of short view term. And this is all the numbers this current year, month by month, compared to last year, month by month. And so as you'll notice, we've seen percentage gains of 14, 15, 16, even 17.5% compared to the 2012 numbers over month by month here. And so that's been a lot of action for sellers. Obviously, they've been pretty pleased with that, getting a higher sale price than they would have just a year ago. So we have all these numbers to look at. Now, that would probably make us tend to believe that we would see more appreciation like this in the coming 2014 year. But let's not get away from the historical data here. And if we scroll down a little bit, we're going to see historical median sale price laid out for us. Over here, it basically ends over in 2004, so about 10 years ago. And as you remember, 2004 into 05 and 06 were basically the peak of the market. We had kind of a little peak in 07, and then the wheels fell off, as we like to say. And so what was happening here is a lot of interest-only loans, a lot of no documentation loans. People were not putting any money down. They would get an 80% loan and then another 20% loan, so they didn't have any money of their own in the property for equity. And then they also had adjustable rate mortgages that started off with a teaser rate of 2, 3, 4%, but after a certain period of time, usually 3 or 5 years, it would adjust back up into a much higher rate. And that's really kind of what caused the domino effect, so to speak. So that's what was going on, and that's really a reason why all these sale prices were able to be so high. You see the actual peak was in 06, and it was over, I think, $235,000 for the median sale price, which is super high. So obviously we came way down in 08 and into 09 and even 2010. And then 2011 is kind of where the bottom of the market happened. In 2012 and 13, we've seen pretty good rates of appreciation. However, we're starting to creep back up over that $200,000 mark for median sale price. And I think over the next coming months and into 2014, probably even into 2015, we're going to see a tapering off of the percentage increases that we're seeing up here. It's probably going to be more in the single digits of 5, maybe 7, 8, 9% increases year over year. And the reason why I think that is because something that has been causing prices to go up over the past 2 years is the Federal Reserve's quantitative easing program. They've been buying up mortgage-backed securities, which in effect have been keeping interest rates artificially low. And so they're going to start tapering that in 2014. And so I think that that's actually going to have a rise in interest rates, maybe 0.5%, 0.75%, maybe even a full percent. And what that means is that interest rate affects what the monthly payment is going to be on a house. And as the monthly payment goes up for the same sale price, the sale price is going to come down as an effect of that. And so I think in 2014 we're going to see a shorter rate of return here, or a rate of appreciation rather, when we look at 2014 compared to what prices were in 2013. Now, another very interesting number to keep track of, and which can kind of tell us where the market is going, is the monthly supply of inventory. And what this measures is the buyer demand versus the seller supply. And so this says if no new houses came on the market today, how many months would it take for the current level of inventory to be bought up according to the current buyer demand that is being seen right now. And if you look at these numbers, it's pretty drastic here. The plus minus percentage over on the right hand column, 30s, we've got some 20%, we've got some teens. Most recently, December, 18% less monthly supply than last year. So that's a big drop in the monthly supply. Again, scrolling down to look at the historical numbers, you'll see that back when the peak of the market was happening in 05, 06, we had about 4, 5, 6, 7 months worth of inventory, and then things just got way out of control when the housing market crashed and we had the financial crisis and everything going on. We had 10, almost 11 months worth of supply of inventory here in the greater metro area. And so this came down back into the 6, 7, 8 range in 2010 and 2011. And then in 2012 and 2013, we actually went back down lower than we were in the peak of the market back in 04 and 05. So this is very interesting to note. Now, a couple of questions that we should ask ourselves. Why are we seeing this drastic drop? Well, two real main reasons, and they both are related to the demand and the supply. As far as buyer demand goes, we talked about the interest rates being held low over the past few years, and that's really been driving a lot of not only first-time home buyers to enter the market and buy their first property by locking in a low interest rate, but also a lot of move-up buyers who maybe couldn't or didn't want to move in the past several years. Finally, here recently, they've been able to, and part of the reason that's been driving them has been locking in a low interest rate on their next more expensive home. We call these move-up buyers. And so that's kind of on the demand side. On the supply side, we've seen a very low supply of houses recently because of two major factors. Number one, we've seen a lot less short sales and foreclosures coming on the market because a lot of those loans that were being made in 05, 06, 07 and before that had already been, the adjustable rates had already reset. And whoever was going to lose their home basically lost their home between 08 and 2011 for the most part. And so that's factor number one. Factor number two was since the recession started back in 07 and 08, a lot of the new construction just grinded to a halt. I mean, there was very, very few brand new homes being built unless they had a buyer that was right there willing to write a contract and make a deposit on that land and start building a home right away. And so we've had a reduction in new inventory, and then we've also had a reduction recently in the short sales and foreclosures. So until we can get some new houses being built, I think we're going to see a low level of inventory for the next year or so. And along the lines of buyer demand, we talked about maybe as interest rates creep up, sale prices will come down. Well, I think as interest rates do creep up a little bit with the Fed's quantitative easing tapering soon, I think we're going to see buyer demand taper with that a little bit. And people may say, well, I wanted to get a really low interest rate, but since they're going up now, maybe I'll wait another 6 months or 12 months or a year and a half, continue leasing, build up some more savings, build up my credit score, and all those types of things until they finally want to buy their first home. So I think a lot of factors are at play here. I do see 2014 still being a great year to buy a house. It's a great year to sell a house if you've been sitting on one for a few years and want to buy up to that next one. Again, keep in mind, we're talking about these interest rates going up. It's not like they're going up 5 or 8% from what they were. I mean, these are still historically very, very low interest rates. So if you can lock in a 30 or even a 15-year mortgage right now in the next year, you're going to be sitting pretty good financially for the next several years.
So I hope you enjoyed some of those numbers there, just taking a look at where we've been, where we're at right now, and maybe look ahead into the future. So give me your thoughts, questions, if you have any thoughts on the market here, if you're thinking about selling, maybe moving up into a bigger house, or if you're moving out of state, maybe you're a first-time home buyer. Would love to help you and chat with you, whatever the case is. So thanks again for stopping by. Have a great day.